Grandpa Buff took a hefty position in Barrick Gold recently, which is surprising because he's not normally a fan of gold. So what's going on and what does it mean for the precious metals markets? That's what we're going to go over in this video. But if you haven't already, make sure you first take our free training, which teaches you our strategy of how we trade these markets. Same strategy I use and a bunch of our Fallible members use as well. Link in this video and down below in the description and comments. Really solid strategy, easy to use, and has great returns. Check out the training, it's free. So like I said before, Buffett is not usually a fan of gold. He's said many things against owning gold. He's all about those companies with cash flows. We got a bunch of quotes from him here that pretty much explains how he feels about it. Gold gets dug out of the ground in Africa or someplace, and then we melt it down, dig another hole, and bury it again, and pay people to stand around guarding it. It has no utility. Anyone watching from Mars would be scratching their heads. Buffett, what's his MO? Investing in companies with cash flows that pay. He wants good businesses, so of course he's not gonna like gold that doesn't produce any cash flows. He's not a precious metals, commodities type guy. He's the old school value investor, great businesses at great prices that you hold forever. And that's what he admits here. He's not a commodities guy. The problem with commodities is that you're betting on what someone else would pay for them in 6 months, aka speculation. The commodity itself isn't going to do anything for you. It's an entirely different game to buy a lump of something and hope that somebody else pays you more for that lump 2 years from now than it is to buy something that you expect to produce income for you over time. And when it comes to commodities, which includes precious metals like gold, it is mostly speculation if you're investing in them. All the great traders in the 70s from Commodities Corp, they were all commodities traders. All the trend following that you heard about started there. The only people who aren't trying to speculate to make more money are the actual commercial hedgers. But in that case, it actually is kind of speculation too, because they're just trying to lock down a price for the materials that they need to build their product. So for example, McDonald's, to make their chicken nuggets, they need to lock down prices for chicken. And a funny story is that Ray Dalio actually put together that financial engineering for them back in the day. So Ray Dalio gave us the chicken nugget. But anyway, all this speculation is not Buffett's forte. Gold is a way of going long on fear, and it's been a pretty good way of going long on fear from time to time. But you really gotta hope that people become more afraid in a year or 2 years than they are now. And if they become more afraid, you make money. If they become less afraid, you lose money. But the gold itself doesn't produce anything. So Buffett's talking about gold as a hedge for fear. People start buying gold when they're scared. That is something that we don't necessarily agree with, which we'll go over in a minute. With our macro analysis at Macro Ops, we look at gold differently. We have a different framework for analyzing it. I will say this about gold. If you took all the gold in the world, it would be worth about $7 trillion. And at the time of the quote, 7 trillion is only about a third of the value of all the stocks in the United States. With 7 trillion, you could have all the farmland in the United States, and you could have 7 Exxon Mobils. And you could have trillions of walking around money. So if you offered Buffett a choice between a bunch of gold or anything else, he would go with the farmland or the Exxon Mobils. Once again, he's all about cash flow. Gold is not cash flow. He also mentioned that gold is a huge favorite of investors who fear almost all other assets, especially paper money. So this kind of goes more in line with our analysis framework for gold, but it's not really about the fear of paper money either. It's not a huge inflation hedge. I know, sounds crazy, but we're about to get into it. When it comes down to it though, Buffett's opinion on gold is that it's a lot better to have a goose that keeps laying eggs, like actual cash producing companies, than a goose that just sits there and eats insurance and storage and a few things like that, which is how he looks at gold. So he does not want a golden goose. But regardless of why Buffett is buying, we know that there has been a huge run in precious metals. Like, look at this chart of silver right here. But what's it even mean? Why is gold running like it is? Do people think the dollar is going to be dead? They might, but that's not why gold is running. Let's get into this macro framework of how to analyze it. So again, this is coming from our research firm Macro Ops. And the first thing is that analyzing gold has little to do with inflation or crisis insurance. So the right way to analyze it is not as a hedge against the dollar dying or fear, which would be that crisis insurance. The framework falls under the acronym RED. So that stands for relative size, expected real returns, and demand. So you'll see as we go through this, analyzing gold goes back to analyzing supply and demand. Just like every single other economic asset, it all goes back to those basics, those Econ 101 things that you learn. So the first thing we got to look at is relative size. And less than 15% of the gold mined throughout history is held in investment form. And gold's total market cap is somewhere between the ballpark of 1 to 2 trillion, which I know doesn't match with what Buffett said just now, but I think we're just talking about in investment form right now. But the comparison still holds, whether this is 1 or 2 or 7, because the global capital capital stock, which is equity plus debt, is in the realm of 250 to 300 trillion. This creates a positively sloped investment demand function. And that's just a fancy way of saying that there's a lot of money chasing after very few goods. Big demand, small supply. So what influences that demand then? What makes people want to buy gold? Well, that comes down to expected returns. And not the expected returns of gold, but the rate of return available on alternative assets. So because gold is a non-perishable metal, doesn't go away, you can't use it up, and the amount mined each year, meaning the new amount of gold coming in, is very tiny relative to the existing stock, because there's not just more gold produced every day, there's a finite amount that you got to mine out of the ground. We should focus on the latter in our supply and demand calculations, meaning you could pretty much assume that the supply is constant, so that the only change that you should be analyzing is the demand. And then what influences that demand is the expected real return offered on other assets like stocks and bonds. So the demand for gold only becomes positive, people only want it when they can't get a return on anything else. So that leads us into the last part of the framework, which is demand. So because the supply pretty much doesn't change, just a small change in the demand can have a huge impact on the price of the metal. And remember the basics, when there's a small supply and a lot of demand, the price of something is going to shoot up. If there's a lot of supply and a little bit of demand, then the price falls. But in this case, you could assume the supply doesn't change, so you're only looking at demand, whether it's high or low. So those demand preferences for gold are driven by the expected real returns of stocks and bonds. So that's why gold pretty much tracks the real yields on bonds very closely. When bonds are not offering a good yield, then the price of gold goes up because people start piling into gold. And vice versa, if people are getting a good return from bonds, then they get rid of their gold. You could see the same thing with capital markets. So if the expected return of capital markets is 10%, then gold becomes negative 8%. And it's a whole inverse relationship. Capital markets are negative 2%, gold is 22%. So over the long run, and this is how Dalio looks at gold as well, the price of gold will approximate the total amount of money in circulation divided by the size of the gold stock. And it's not inflation or deflation that's the principal driver of gold, or fear or anything like that, but the expected real return from other long-term financial assets, particularly equities, so stocks. So using that framework, we could pretty much say there's a high probability that the bull market in gold is going to continue for the foreseeable future. We know that the global money stock has exploded and it's continuing to rise because Powell can't stop printing. No one's going to stop printing. More and more money is coming to the economy. And at the same time, the expected real return on financial assets is very low. I know the stock market is constantly going up, but the expected return is low. It's even negative in some cases. Here's GMO's 7-year forecast. You can see US large caps have expected return of negative 1.5%, and small caps are only at 1.4%. Bonds on this side are even worse. And the historical long-term average is 6.5% for these equities and stocks. So given this, it's no wonder that gold prices are shooting up. So yeah, maybe it does make sense that Buffett is buying these gold companies because we are in that long-term bull trend. And really, it's not Buffett directly buying this stuff. It's more the people that are working for him that are slowly taking over because, Buffett's old. So I don't think Berkshire is going to stay the exact same when someone else is managing it. You're going to see different investments like this gold play. Now, we've been tracking gold over at Macro Ops because we've been playing it in and out of the trend. So gold right now is on a 15-month uptrend buying climax on a monthly basis. You can see that right here. Here's a monthly chart of gold. It broke out of this pattern and it's been flying higher since last year. But as we mentioned, it's kind of a buying climax right now. They're extremely overbought and they've been working off those levels over the last week. Now, the long-term path of least resistance is up, meaning gold is going to remain in this bull market, but you can expect higher volatility in the near term. So this whole Buffett buying gold thing is pretty much the cherry on top for the bullish gold narrative. It's become consensus. Everybody is long gold. Last week's small speculative positioning hit its highest level on a Z-score basis since January of 2003, which the last time this happened, there was a huge retracement in the metal. And what do we know about sentiment and positioning? If everybody's on one side of the boat, well, then the boat is going to tip, right? So if everybody's super bullish on an asset, that's when you could see it turn around because all the money is already there. People are leveraged. There's no more money to come in and push the price higher. What's better for an asset like stocks, gold, whatever it is more bearishness, because that means people still have yet to invest in it. So whenever you get extreme sentiment or positioning in one direction, you got to look to the other direction. In this case, we got to look for gold to fall. Gold is also near the end of its positive seasonality and it's under pressure from rising real yields. And you can see that right here, bonds have been dropping recently. And when prices of bonds drop, the actual interest rates go up. It's inversely related. And what do we know from our framework that we just went over? If you're getting better yields in bonds, then you're not as interested in gold. That's going to put some downward pressure on the price. So in the macro ops portfolio, which is a global macro portfolio, we've actually went short silver today. And I'm recording this video Tuesday afternoon. And like I said, we're bullish on precious metals as a whole, but we have been playing the short side. Last time we shorted silver was right here, and you could see it made a huge drop. Made some good money on that. So we're shorting again today, entered around 26,610, and our stop loss is at 27.1. So up here, pretty tight stop. And again, this is a very short-term trade. It's kind of like a mean reversion trade. We're shorting it for a few days and we'll recover pretty quickly. Now, the strategy I talk about in this training, which you should definitely check out, there's a link in this video and down below in the description and comments. We don't actually ever trade gold. We just stick to stocks, specifically stocks in the NASDAQ. And that's the thing. It's interesting to talk about Buffett and what he's doing and what other traders are doing, even, what Alex is doing at Macro Ops, my partner. But when it comes down to it, you should be sticking to your own strategy. Just because someone else is trading precious metals doesn't mean you need to as well. I've already fallen for that trap. I've traded global macro, I've made money and I've lost money. At the end of the day, I went back to the strategy that I like the best, which again is all focused on stocks, and you can learn more about it here. But at the end of the day, you got to remember it's okay to miss out on some trend or opportunity in some market, because that's always going to be the case. Now, if you are a global macro trader, then yeah, you would be in various different markets. Otherwise though, it's okay just to stay in one. There's a lot of opportunity in that market as well. Still make a ton of money. Now, if you like this video, make sure you subscribe, because what we're going to do in the following videos is go over how to analyze the dollar, because a lot of people think the dollar is going to collapse, and that's one of the reasons they're getting into gold as well. Or it's why they think that gold is going up. But this whole dollar collapsing thing is not happening, and we're going to explain it in the future videos. So if you want to see those, make sure you subscribe, and I will see you there. Stay fallible out there. Bye.